Start recording. Right, there we go. Right, welcome everybody. We're our capital raising event to learn how to raise money, what the pitfalls are, what position you need to be in to actually talk to investors. And I will then talk a little bit later on about actual events, how you pitch, what you need to do, how many people you need to talk to, etc., etc. Now, I'm going to be quiet. If we're going to start with Dan, who's from Forresters, who are IP trademark attorneys, and over to you, Dan.
Okay, thanks, Neil. Hi, everyone. Yeah, I'm going to talk to you today about how to get your IP investment ready. I've got a few slides. There's quite a lot on there, but yeah, Neil's recording this, so if you want to go back to it later, then you'll have a link to the recording. So I'll just share my slides now. Oh, sorry, everyone. Okay, hopefully you can see my slides. Okay. Oh, sorry. Okay, so let's look at some the main forms of IP, which I'll be talking about today. Patents, trademarks, designs. There are some other forms there, which I won't go into, but they're good to be aware of. So it's best to look at some case studies. So kicking off with trademarks. Now, a registered trademark can protect your company name, your product name, slogans, graphics, logos, that kind of thing, basically your brand. And here we've obviously got the McDonald's trademark and the registered trademark symbol. And if you're an early stage startup, you're probably thinking, what should I call my company? What should I call my products? My advice would be, if you want to stand a better chance of being able to register your mark as a registered trademark, you should choose a name which is distinctive and not descriptive of the goods or services that you're operating in. The great thing about trademarks is they last indefinitely, provided you pay your renewal fees every 10 years. So yeah, really important for protecting your brand and your place in the market and stopping others from trading under your name. Moving on to registered design protection. Now, a registered design, this is another form of IP. It protects the appearance of the whole or part of a product. It's relatively easy to get registered design protection. The hurdles are pretty low. The design must be novel in the sense that it's not known already. And it must have individual character in the sense that it creates a different overall impression on designs which are out there already. So yeah, pretty low bar to getting registered design protection. You get protection for up to 25 years, provided you pay your renewal fees every 5 years. Now, yeah, as I mentioned, registered designs are relatively easy to obtain, relatively cheap. They're fairly narrow form of protection in that they're limited to the look of your design, but they can be really effective for stopping copycats coming onto the market. And more recently, they're really useful for online marketplaces for supporting takedown notices if you notice knockoffs going on sale on Amazon or eBay, that kind of thing. So they can be really useful. You can register pretty much anything. There's some examples here: packaging, products, sets of products, complex products, parts of a shoe, for instance. Also, yeah, logos, computer icons, typefaces, graphic designs. So the look of anything that you're producing can be registered. So now looking at patents. Now, a patent is used to protect a technical solution to a technical problem, and we operate a first to file system. So it's really important that you get your patent application filed as early as possible. And most importantly, filed before you disclose the invention to the public. Once the invention is out there in the public domain, it's then no longer possible to get valid patent protection in Europe, at least. So, and a patent is it's really your deal with the government. In return for telling everybody how you're doing what you're doing, you get up to 20 years monopoly, a monopoly right to stop others from using your invention, provided you pay your renewal fees every year. And yeah, the requirements for getting a patent, the invention must be novel in the sense that it's new, it's not known anywhere else, and it must be inventive in the sense that it's not an obvious combination of what's known already. These are fairly high hurdles. It's not that easy to obtain patent protection, but that being said, if you've got a good invention and it's the core of your business, then it's a really important thing to have to stop others from using your technology. Thirdly, that the invention mustn't be excluded from patentability. And there are various exclusions like mathematical methods, methods of treatment, that kind of thing, that are excluded. So me as a patent attorney, my job is to steer around these exclusions and get you patent protection. Yeah, it's for instance, it's definitely possible to obtain patents for software related inventions, despite the computer program exclusion. So that, yeah, the process runs roughly like this. You'd file your initial priority application, and we usually recommend filing in the UK first because it's relatively cheap. The official fees are low, and you get your search report back pretty quickly from the patent office. So within 3 or 4 months, you'll have a search report which will give you a good indication of whether you're likely to get a patent and what the scope of protection might be. So that can be useful for then determining the rest of your IP strategy. If it's looking good, you want to go for international patent protection in other countries, then provided that you file your foreign patent applications within 12 months of your UK filing date, your overseas patent applications will be effectively backdated to your UK filing date. And yeah, you'll need a patent in every single country or jurisdiction where you want protection. So your key markets and where you're manufacturing, that kind of thing. Now for startups, the usual route is to file in the UK first and then file an international patent application. Now, this doesn't mature into an international patent. There's no such thing, unfortunately. It's really a vehicle for keeping the door open for filing patent applications in almost all countries around the world. So it buys you an extra 18 months in which to A, decide where to file, and B, to raise the funds for these foreign filings, which can get pretty expensive. And here's an example. This is an rather ancient iPhone. There's so many forms of IP here. Apple and iPhone registered trademarks. The technical operation of the phone itself will be covered with hundreds of patents. Apple will hold some trade secrets which they keep back and keep in-house. The appearance of the phone itself will be protected by registered designs, as well as the graphics and the user interface. And finally, the code running on the phone, that will be protected by copyright. So what do your investors want to see? Firstly, are you going to get sued by somebody else who already has IP protection in place? You can investigate this by doing a freedom to operate search and analysis. It's a good idea to look at your main competitors' IP portfolios, work out what you're doing, make sure you're not treading on anyone else's toes. Secondly, have you protected what you're doing, and how have you protected it? Have you got an IP strategy? And what I mean by that is, have you identified what IP you have? Have you planned your initial IP filings, patents, trademarks, registered designs, that kind of thing? Get some search reports, work out whether you're able to get patent protection, and put together a pipeline going forward on how you're going to file for your IP protection. And lastly, I'll mention the patent box scheme. This is a government scheme in the UK, which it allows you to reduce your corporation tax payments when you eventually pay corporation tax on profits derived from a patented invention, and it reduces the corporation tax from, I think it's 19% at the moment, down to 10%. And the reduction is on the worldwide profits, so it can offer some pretty good savings on your tax bill. And a quick sales pitch here. How can Forresters assist you? We're offering free 30-minute consultations. At the moment, this is by video or in person in normal times. We can put together an IP audit to look at your business, work out what IP you have, put together an IP strategy for you, and work out what you need to file and when, and where you can get protection. Yeah, we can put together fixed price quotes for filing in various forms of IP. And lastly, we can look at your competitors and do a patent landscape, work out whether you're free to use your technology and not infringe others' IP. So yeah, we've got quite a big team, specialists in all different fields of patents, biotech, as well as technology and engineering, which is where I am, and a trademark team as well for brand protection. And I'll just finish by talking about a bit of a success story here. And this is an illustration about how having the IP protection in place can help you develop your business. And so yeah, this guy came to us. He's a garden shed inventor, quite literally. He developed this marking tool, which is effectively sprays a chalk cross on the wall behind a cabinet, it's for marking out the drilling points in a wall. So you hold the cabinet on the wall, spray the cross through the hole, and this is apparently much easier than using a pencil, which is what most builders do. And so yeah, we helped him by doing an initial background search to see what else was out there like this, and we drafted and filed a UK patent application. That went to grant. We filed an international patent application and got patent protection for him in his key markets. We registered Marksman as a trademark in all the key markets again. And we helped him go on Dragon's Den, and yeah, all 5 dragons offered to invest. Off the back of that, this is now stocked in all DIY stores across the UK. So yep, so that's a quick example of how IP protection can help. And yeah, I realized this was a very quick run through. So if you have any questions, I can see there's a few things in the chat box. I will be happy to answer those. I'll just stop sharing my screen now. Okay, so yeah, thanks everyone. We've got a question about PCT. Does going for a PCT application offer a form of international protection, or will you need to seek individual patents for each country in which you operate? So yes, so you do need to seek individual patent filings. You need a separate patent in each country, and yeah, so once your PCT application has expired at 30 months, you will need to file separate foreign patent applications. So there's quite a bit of cost in doing that, and But the good thing about the PCT route is it buys you time to decide where you want protection and to raise these filing costs. I can't see any more questions at the moment, but yeah, I'm going to hang on here. So if anyone else has any questions, do drop them in the box. I'll put my email address in there as well. So do reach out to me if you've got any queries about IP protection. And yes, I'll paste my email in. So I think that's it from me. It was a pretty quick run through. I will hand back to Neal and then over to Anthony, I think.
Thank you very much, Dan. Just before we introduce Anthony, the founder and CEO of SeedLegals. Oh, there's a question for you. I'd just like to say, sorry, Dan, just one second. We get approached by many investors. A number of, and quite a large percentage of, will be only looking at companies that have some sort of IP, because that's their formula, that's what they work on. So it's a vital part of your capital raise, your product protection, everything else, to seek advice. And obviously on the basis that you get a free 30-minute consultation. And I've done a number with Dan's partner, Charlotte, who's also presented on here many times. Extremely useful and so beneficial. So that's all I can say. Sorry, Dan, carry on. Answer.
Thanks, Neal. It's good to hear. Yeah, so a couple of questions. You mentioned software protection. When does it make sense to look at doing more than just copywriting the code? Now, this is a great question. Now, so it is possible to patent a software invention, provided that the software produces a real-world technical effect. And so, yeah, firstly, it is possible to get patent protection for software. Now, the second question is it for some software inventions? So if you've got an AI sitting on a back-end server, nobody's going to find out how it's working, what it's doing. So in that case, it's sometimes better to decide not to patent the software, because by doing the patenting process, you'll be divulging your secrets to the world, and in return for getting patent protection. But at the end of the day, that patent might be difficult to enforce, because it may be hard to actually work out what people are doing if they're copying you on some server which you're not able to access. So there's different things that you have to think about whether if you're deciding whether to go for patenting your patent protection for your software. But I would add that a patent offers significantly better protection than copyright. Copyright is a very narrow form of protection, which can be avoided easily by simply rewriting the code or making small changes. So yeah, hopefully that answers the question. The next one, do you help with design for finding licensing deals? I don't personally get involved with writing licenses, but I could assist with writing the IP clauses of contracts. So I'm not sure if that answers the question about that, but yeah, that's all I'm going to say, I think. So yeah, if anyone has any more questions, then yeah, drop them in the box or send me an email. Otherwise, I will stop talking and hand over to Anthony, I think.
All right.
Back on, sorry. Anthony, I'd just like to, whoever doesn't know Anthony Rose should do, especially if you're looking at raising capital. I think I read a quote the other day, Anthony, from somebody who said that you were the leading figure in the startup world in the UK. And I think that's enough to start with. So I would like to introduce you to Anthony Rose, the founder and CEO of SeedLegals.
All right. Now I've set a high bar. I need to deliver. All right. So, hey, everyone. So I'm Anthony from SeedLegals. If you're looking to raise investment, don't go to a law firm. SeedLegals is a place to go. So what I wanted to talk about is the 10 things to do in order to become investment ready and have investors want to invest in your company, and how to do the right sort of things for the next step. And of course, you can do these on SeedLegals, but I'm not here to push SeedLegals. I'm here to show you the things to do for your capital raising. So what I'm going to do is I'm going to share my screen. By the way, there's a little slider on Zoom, so you can move the image screen share to the side, and that means you can get bigger people and smaller screen share, or you can set a gallery or other view. So here are your Zoom top tips so that you can have set the experiences you like. Okay, so thing number one is usually what happens is a couple of founders get together and you have an idea. And then you go and incorporate on Companies House. And it's super easy to incorporate your company. But the trick is just do what is market standard and make maybe 100 shares at a penny or a pound each, and ordinary shares. Sometimes we have companies on SeedLegals who tell us their accountant said, make alphabet shares. These are A, B, C, D, E shares, and giving the founders 2 votes per share and all sorts of things. 100% of the time we see people do these, it has to get unwound afterwards, because investors are not interested in investing in companies where the founders are trying to kind of do a one over the investors. And it creates huge complexity later. If you try and sell your shares, you can only sell it in that share class. So keep things simple, ordinary shares for the founders, split however you like between the founders is thing number one. Thing number two is generally here's the pattern on a growing company. So a couple of founders get together, incorporate, give some shares to each other. And then, of course, you don't have any money. So that now you find yourself a CTO, which is typically the first hire, and you want to give them maybe a small amount of money and some equity instead of money. And the question is, should you give them shares or share options? So here's the rule of thumb, which is if the shares have no value, which is generally right after you've incorporated and before you're trading and well before a funding round, then you can easily give shares to new team members or joining founders. But if the company has a value, which often means for most startups, as you're approaching a funding round, you've got a term sheet out, you're talking about a £500,000 or £1 million valuation. If you give shares to people for free, as opposed to investors who buy them, then there are tax implications. And so if you were to hire a CTO as an employee and give them, let's say, 5% equity, not uncommon, and you decided the company had £1 million valuation, that would be £50,000 worth of shares. And the company would have a tax liability as if they had paid the employee £50,000. And that means there would be PAYE and national insurance and all sorts of things. The company may have a tax liability, and the employee may have a tax liability as if they'd received £50,000, which would be a real problem because the person may have a tax bill, but not able to sell their shares anytime soon. So the rule of thumb is if the shares still have no value, you can give out shares. If the shares have a value, like close to a funding round, create an option pool and give people share options instead. And we can help you with all of that on SeedLegals. So the next thing, of course, if you are going to give out share options to team members, how many options, what size option pool should you create? So an option pool is there to incentivize your team members. So the founders start off by owning the shares in the company, and because of tax reasons and others, it's not useful to give shares afterwards. So you can give options, and an option is the right to buy a share in the future. Now, when you create a so-called option pool, this says you're creating a reserved area to give options to team members. When you do that, you're going to dilute all the existing shareholders. And investors don't like to be diluted right after they've invested in your company. So the normal time to create an option pool is as part of your first funding round. And there, the norm would be, I would say, half of companies, based on our data on SeedLegals, create an option pool, and the typical size is a 10% option pool. So you're reserving essentially 10% of the number of shares you've got to be able to give your employees share options. American companies, that number might be more like 20%. In the UK, it's more like 10%. You'll often find that investors will tell you to create a bigger option pool than you really need. This is so that they don't get diluted in the future. But the problem is, if you make too big an option pool, you're just diluting yourselves as founders and existing shareholders unnecessarily. But let me take a step back from here, which is the biggest problem we see on SeedLegals today with companies is not problems between founders and investors around funding rounds, but it's between founders and founders. So it looks like about 10% of the time founders fall out. It seems to be a lot more fashionable these days, maybe with everyone working at home and COVID and things are more difficult. There are a lot of founder fallouts. And when there are founder fallouts, imagine that two founders got together and started a company and got 50 shares each. And now they split up. If you don't have what's called what we call a founder agreement in place, the departing founder might keep all of their shares. And then the company's basically uninvestable. So there's something called a founder agreement. You can do that for free on SeedLegals. And a founder agreement is between each of the founders and the company. There are different models, but that's our model. And it says basically three key provisions. One, what's called reverse vesting. So it says if I leave any time in typically the next 3 years, I have to transfer back some of my shares back to the company. So if I leave a week later, I need to transfer back 99% of my shares. If I leave 3 years later, I've got all of my shares and own them. And this is essential so that if there is a founder fallout, the departing founder needs to transfer their unvested shares back to the company, which can then use them to give to a new founder or team members or something like that. But importantly, an investor is unlikely to want to invest if they see half the company's equity is owned by a departed, disaffected founder. The next thing is that it contains, a founder agreement contains IP assignment provisions. So when you get together, you've had ideas, you've started noodling on things, sometimes even before the company was started. And what you want to avoid is a departing founder going, no, this is my idea. I own the code. You can't go and do anything with it. And then you're stuck. And not only will investors, if they see this dispute, not invest, but it may turn out you're now in a dispute and you can't even continue with your own idea. So it's essential that everyone, when they join the company, assign any IP they've done in this project, not everything they've done in their life or in separate things, but related to this project is assigned to the company. So if they leave, it's a clean break and the company continues. And the third provision that a founder agreement has is to say that if I leave, I won't try and solicit people from the company or customers, and I won't create a competing company for some number of years, typically 2 years. Because the last thing you want is you have a dispute and the other co-founder goes, well, that's it, I'm out of here. I'm just going to start a competitor and nick your team. So the whole point is investors and people put their effort into creating a company. Investors put their money. And this company now needs to be the vehicle that continues, even though people come and go. So when we have on our web chat on SeedLegals, someone drops us a note, help team, my co-founder's leaving, what to do? Our first answer is, do you have a founder agreement in place? If so, it's still going to be a bit of a drama with your team, but at least there's a mechanic to say in place, transfer back these shares. You won't have them trying to nick your team, hopefully, and that's contractually assigned. But if you haven't got a founder agreement in place, then it's pistols at dawn, and bad things happen often with the company in that case. So do your founder agreement, and it's free on SeedLegals. So now you've got your team sorted, you've got your founder agreements in place, and you've given some shares or share options to early team members, and it's time to go fundraising. So the first thing you want to do is to know about SEIS and EIS, and most founders know about it. In 30 seconds, for those who don't, the first £150,000 that your company can raise, £150,000, offering investors SEIS, which means they get to write off 50% of their investment against their tax. It's a little known rule that they can write it off against their tax not only in this tax year, but they can backdate it to last tax year as well. So that makes you way more investable if you can offer SEIS. And once you've used up your £150,000, you can then do like £15 million in EIS that gives investors a 30% write-off. And in both cases, if they keep the shares for 3 years, they pay no capital gains tax. And if the company goes bang, then they can write off their investment as well. So it's hugely popular. Maybe 80% of all early stage investment in the UK is from angel investors investing, looking for their SEIS and EIS. So you being able to offer this makes you much more investable. And for that, you often want to get what's called SEIS advance assurance, which means you write to HMRC and they send you a letter that says you can tell your investors they will get their SEIS or EIS. Now, this isn't legally required, but investors, for the most part these days, ask for it. So if you do your SEIS advance assurance, which you can do on SeedLegals, then it's often the difference between an investor saying, fantastic, I'm in, where do I send the money? Send me the deal docs, versus sounds fantastic, tell me when you've got your advance assurance, I'll be back later. So it's a useful thing to do. So the next thing now is you now want to raise money. And the question is, how do you value your company? Do you read TechCrunch and see people raising with astronomical valuations? Do you talk to your accountant? Do you just make up a number? So here, somewhat facetiously, is what not to do. So thing one, read TechCrunch. These are all crazy American valuations. You need to take at least 1 0 off the end. Thing number two, you might take a spreadsheet and model your future revenues. But there, people just make stuff up. And I've seen, things that show 100 million a year by year 3 or 4. And then therefore my valuation is like 10 million. But no, this is BS. These are made up numbers, and the astute investors know that. You can also ask your accountant, and your accountant will say, are you making any revenue? You go, no. Do you make profit? No. Are you losing money? You go, yes. Are you about to make money? You go, no. And then they'll go, so why is the valuation more than 0? So that's no good at all. So there's a fourth method that we've seen on SeedLegals, which is basically the amount that you want to raise is going to be, you're going to be selling 15% equity, is the median amount that companies sell in a funding round. So the investors will own 15% of the company after the round. Occasionally, an investor will ask for 30%. Be super careful not to do that, because you'll find yourself uninvestable fairly soon. If you're giving away or selling 3%, that often means that you could be raising more, or your valuation is way too high. So 15% seems to be the median for funding rounds. And this means that you can basically take the amount you want to raise, multiply it by 5, so the investors own 1 in 5 plus 1 in 6, which is 16%. So you figure out, I'm looking to raise £100,000 on a £500,000 pre-money valuation. And this is your standard pattern for UK startup fundraising. And being in the standard pattern makes you much more investable, because when investors go, oh, right, I see many companies, you pre-revenue, therefore your valuation's in this band, this is what I'm expecting. So here, somewhat facetiously, are the valuations that one might expect to see. A couple of founders get together, have a PowerPoint presentation, 300K valuation. You've built a prototype, great, 500K valuation. You've got something built that's live, 800K. Oh, you've got a bunch of people using it, a few thousand people using it, £1 million. You've got revenue, £2 million valuation. And north of £2 million valuation, the valuations often, a rough rule of thumb, depends on the rate of growth of the company, but it might be 10 times annual revenue. So if you're doing £30,000 a month in revenue, that's £360,000 a year, you might expect maybe a £3.5 million valuation. If the rate of growth is amazing, 10x year on year, it might be higher. If the rate of growth is pretty flat or the revenue is very sporadic, it might be a 5x or even less. So it's all about trying to then find the right valuation for your stage of development, so that investors, if you tell them I'm raising at a 3 mil valuation, they're going to expect that you have revenue. And if they go, great, what's your revenue? You go, no, I've just got a PowerPoint presentation and a dream. Then they'll go, love what you're doing, come back later, or pitch me on a more realistic valuation. And if it's just the dream and the PowerPoint, it would typically be sub £1 million. Now, of course, if you have an amazing track record as a founder and you've sold your last few startups for millions, then the rules are very different. But if you're a first-time founder, you can probably expect that kind of pattern. And that means normally funding rounds in the UK will be founders put, our data shows a median of £26,000 of their own money into the business upfront, because you need to put some money. People won't invest on a PowerPoint. And then you might raise £50,000 from friends and family. And or you might raise £150,000 or £200,000 from angel investors. And then you might raise £500,000 to £800,000 in a seed round. And then you might raise a couple of £1 million on a Series A round. And if you can arrange that each time you're diluting by 15%, then after 3 rounds, the founders still have more than 50% equity, which is really important, because then you're still majority shareholders. So once upon a time, you had to raise funding in these big or go bust rounds every 12 to 18 months, raise enough to last you for longer. But now on SeedLegals, we've got agile fundraising, which means, let's say you wanted to raise £200,000 and someone comes to you tomorrow going, hey, I love what you're doing. Can I invest 20K? Instead of going, no, come back later, you can go, yes, let me send you a seed fast agreement that says you give me the 20K now, and I will give you shares when I do my next funding round. And you'll get shares based on the valuation that we'll agree later. And because you give them money now, I'll give you a 10 or 20% discount. So a seed fast is a way to raise money ahead of a funding round. But another problem we find with companies is they go, I want to raise 200K, but I've got 150K committed. What do I do? So we say you can do a rolling close round, which means you can close a smaller amount faster and then top up later with what we call instant investments. It's a deed of adherence. It says, I'm joining your last round on the same deal terms, but at the same or higher valuation. So all of which is to say, my goal at SeedLegals is to help you both raise faster and more efficiently and more sensibly, but also to avoid these big, stressful, I can only raise every 12 to 18 months in a new round, and transform it into opportunistically, hey, I've got my article written up in the press, I've got lots of interest, can I now do a fundraise? Or if people are calling me saying, can I invest? Can I take your money, give you some shares, either now or later, and use that investment to grow the business, to increase the valuation in a more, I guess, agile way. So that's it from me. If you've got any questions, Anthony@seedlegals.com. If you want to know more about valuation and dilution and so on, head over to SeedLegals.com, look in the resources deal data section, and there's a huge amount of data-driven content on how many shares or what percent equity to give to advisors, to give to team members, company valuations, and more. So thank you very much. And any questions, if you want to pop them in here, I'll take a look at the questions now. So self-funded equals...
Yeah, sorry, I was going to say, thanks very much, Anthony. You've got a few questions, so I'll let you carry on. And anybody else who's got any questions initially now, put them in the chat and we'll have a little open forum at the end.
All right, so a question from Sikandar, which is self-funded equals self-indebted, a fun phrase. So how do investors react to bootstrap companies that use some of the funding round to pay back some of the debt? So that's a great question, which is, firstly, investors are unlikely to invest just in an idea. They want to see something tangible, even if it's some mock-ups that you've done research or whatever. And hence we see founders putting a median of £26,000 of their own money into the business. As my business partner reminds me, you can't own more than 100% of your own business. So at some point fairly soon, it stops making sense to fund it yourself. You should find other people to fund it. Plus at some point, your partner, your wife or spouse is going to notice that you are spending quite a lot of money on a hobby. And so you need to stop doing that and find professional investors. So if you put money into the business, how do you get it back? So one thing is, well, there are three possibilities. One, just write it off. I've put money in, I'll never get it back. I mean, other than I own equity and I'll sell it later. Two, treat it as a founder loan, sometimes called a director loan. We call it a founder loan, and it will be repaid later. And the third one is convert it into equity in a funding round. The most common way is to treat it as a founder loan and to repay it. But what early stage investors don't want is to invest, let's say, 50K into the business, and then you repay 30K right back to yourself. They want your money to stay in the business, and the new money goes to grow the business. So the usual arrangement is it stays as a founder loan until the company can repay it from what's called free cash flow. So in other words, you're kind of cash flow positive, you've got revenue, and now you can use that money to repay the founder. So your goal is to be able to get that money repaid to you, because it's your most efficient tax way of getting the money back. If the amount's modest, 20K or so, the investors will be happy that when you're raising a few £100K later on, it'll get repaid. If you put £200,000 into the company, then it's going to be a bigger issue, because that could be a fair fraction of a round, and the investors don't want their money going straight back to the founder. They want it to be in growth. Okay, so next one is they're coming thick and fast. So I think, so what's the impact when you're looking for funding if the founders are not working full time? That is a great question. So it's a real catch-22, because what you really want is to get funding that you can then start paying yourselves some modest amount, so you can give up your day job and work full-time on the company. But you also have bills to pay and so on. And you probably start off having an idea when you have a day job. So if investors insist that you've stopped your day job before they'll invest, that's a problem. On the flip side, investors don't want to invest when it's still a hobby. what to do? Well, I think there are two ways of looking at it. One of them is you're going to have to make a forward-looking bet to say, I'm giving up my day job. This is what I'm doing, and investors will see that it's full-time. But if you're not really ready for that, then you're going to have to basically assure investors that as soon as the investment arrives, at that point, you're going to give up your day job and do this full-time. So, you might persuade investors, particularly if it's friends and family in super early stage, that you're transitioning. But it's generally any pro investor, as soon as they sense that this is a hobby, they've got other things to do with their money. They want to invest in companies where the founders are on it full time. Now, there's another problem, which is one of the founders is committed and the other founder is still doing this as a hobby. You might address that by having a different equity split between you. You might say, great, let's say the company valuation is £500,000 for now. And the next 6 months, I'm going to be doing this full time and you doing this part time. And were I to be earning a salary, I might be earning 50K a year. And 6 months, that's 25K value, which is 5% equity. So maybe the fact that I'm on this full time means actually I should get another 5% equity or 10% or whatever it is compared to you. So if one of the founders is full time and the other one is part time, you may address that imbalance with a different equity split, which of course might persuade the other founder to start hopping on more faster. So next one from James. So we have a prototype and value our company at around 500K. Sounds about right. We require around 150K to get the product to market. Is there a way of raising money without over diluting? So that's a great question. So if you need the 150K, typically that might then be, I'm raising 150K on a 500K pre-money valuation. So the valuation after the round will be 650K. So that's what, 22% or whatever, no, 18% or something dilution, which is not too unreasonable. But you might want to reduce the dilution. And you can do that in a number of ways. Number one, raise less. Number two, see if you can increase the valuation a bit more to be what you want. Number three, raise initially with seed fasts. So the seed fast says the investor gives you money now, it will convert at a valuation to be determined in your next round. And you then use that money to develop the business, get traction, get launch, and now maybe your valuation is double later on. So you're going to give away less equity overall. Usually this kind of resolves itself because you end up procrastinating, doing more development on your own bat, get something built further, then justify a slightly higher valuation, or just pare back your needs and raise 100K initially and then figure out how you're going to make that work longer. All right, one more question, which will be, so I will go, okay, so Jackie says, if you're pre-revenue in a B2C business, you have 250,000 users, which is amazing, in 200 countries, all right, sounds like a social network, with 1,000% year on year, sounds amazing. You can argue for a higher valuation than typical pre-revenue. So the answer is for sure. So really, ultimately, what investor is looking for, once your business is making millions of pounds a year, the investors are probably not going to care who the founders are. They're not going to care what the business is. They're just going to look at your P&L and your spreadsheet of year-on-year growth and go, love what you're doing. What was it again? Great, we're in. But in the early stages, investors are having to make a bet. And they're either betting on the founders or they're betting on the perceived traction they see. So if you look at Clubhouse, it's got huge amounts of noise. And then people are talking about multi-billion valuation. It's is there anything to it? I mean, you know, billion valuation, they're making no revenue. The numbers of installs are going down, but it's in that hype cycle. So how can you engineer, unlikely to be Clubhouse level, but how can you engineer your own sort of hype or desire that gets investors to want in? And that's really what early stage investment or fundraising is all about. It's showing that growth. And if people are going to invest in either the team or the growth. So it works like this. If you've got revenue, show the growth in revenue. If you don't have revenue, show the growth in users. If you don't have users, show the growth in partnerships with partners, or the PR you're getting, or the development you're getting, or something. If you don't have that, show government grants. If you don't have that, show the expertise of the founders. So you're always trying to work backwards to the thing to show that future potential. So if you're growing, you know, 1,000%, so 10x year on year, of course, you know, in year one, you had 0 users, and then you've got 100 users. You know, initially that number is meaningless, but if you do have 250K users and it's still growing, that is fantastic. And you may well, in that model, have a much greater valuation if you can show that the numbers are growing. You could justify a multi-million-pound valuation. But then the last thing from me is, in the UK, I've done social networks in the past, and in the US, you can get investment just based on user growth without even worrying about a revenue model. But in the UK, investors like to see either revenue from the start, or at least a path to revenue. So if you're going, great, the more users I have, the more I lose money because of server costs, investors in the US might find you attractive. The UK is a bit more difficult. So you're going to have to show, at least in your pitch deck, that how you're going to monetize that fairly soon. Anyway, you can drop me a note on SeedLegals if you want to send me your pitch deck. I'll give you a bit more feedback as well. So thank you, everybody. Any questions? Anthony@seedlegals.com. And now over to Dan B.
Dan B,
Thanks,
that's
Anthony.
now Dan, are we going to run a sort of an open forum here, or do you have anything in particular you want to?
I was going to come up with a few points just to get things rolling, but if
sure.
Anthony doesn't mind, I would like to come in on that point, Jackie, because one of the things Ideas Crucible, that about a third of what we do is advise startups, and I'd be very interested to know why you want to kind of raise your valuation, because I see a lot of startups who are don't currently have any profits and are not currently or very low profits, and they want to raise their valuations, and then they hit hard times, pandemics, there's all sorts of scenarios, and they've got this uber valuation and no one will come in and fund it, support it. So I'm just, one of the things I'd love to have maybe an offline chat is just be cautious of going in with a super valuation, even if you can get it now, because at the end of the day, valuation is what someone will pay for it at the end of the day. And then they realize, you know, maybe I should have held off till things were a little bit, you know, better, and we were more attractive once we get down to the numbers, because you can, as Anthony's pointed out, there's lots of ways you can make yourself look attractive, but you can only play that game for so long.
Yeah, I think that's very much the case. Again, the guys out there and girls out there, or gents and ladies, when you're looking at raising, especially on the early stage, you want to hype the valuation up, you want to raise as much, you don't want to give away as much money. And it's very difficult, because what that does, again, as Dan just said, it affects the investment side of things. I don't know if anybody wants to, we'll open this up, but anybody want to shout at me how much Gates owns of Microsoft? Anybody out there know? All right, Bill Gates owns less than 1.3% of Microsoft. Now, that's some dilution, but it's one of the biggest companies in the world. So, and I'm sure he's sold along the way. When he started, he didn't start at a valuation of X trillion dollars. You know? He's built it, he's gained it. But again, I think the important thing to know, and I'm not advocating complete dilution here, and this is an extreme example, but the difference between what you're looking to initially raise at a valuation to where you're going to exit, which is the other important thing, because your company could be worth £1 billion, but if nobody's going to pay you for it, it doesn't matter. You've got no money. And that's the sort of stage you're going forward. And I'll come on to something on that later. But Dan, back to you.
Excellent. Cool. So one of the key things, just out of interest, this is great, by the way, to see some new faces on this capital raise call. There's one individual I recognize and I've had a chat with since, but there's a whole bunch of new people here. So welcome. One of the things I would, so maybe apart from that new one, where do you think is the best way to kind of get your cash in, and if you're kind of raising at the moment? And it would be wonderful if you want to put in the chat if you are raising, because and if, that would also give us a feel of the people we got here. So where should you get your cash from? See if we can get a bit of interaction going in the beginning. Quiet. Angels we got as one place. Okay, yeah, anyone else? Anywhere else we could go to? Revenue. Okay, thank you very much. Revenue. If you can bring money in by revenue, it is the best way. There's better. Don't immediately crowdsource things. Another way. Friends and family. That's an excellent one as well. Revenue is a great one. Friends and family is another one. Save your money. Excellent. So yeah, if you can put some money in yourself, get some. It shows, and later on, angels and investors will appreciate if you put some skin in the game. Likewise, friends and family are great because they will support you as in case the business has tough times, and and they'll be usually make very good investors. Yeah, you might also consider grants, for instance, crowdfunding, accelerators. Don't immediately think, oh, I'm going to go to some VC. And the reality is, and I get lots of requests to support companies wanting to go to VCs. The reality is most startups are not ready for VCs, and they probably won't be ready for several rounds at the end of the day. They inherently, VCs and actually many good angels are risk averse, which I know might sound contrary to what you might suspect, but they are really risk averse, and most startups would not really ready for that community. So and this is something else. I've been working in innovation for 20 years, and one of the most disappointing things people realize after end is ideas are cheap. There's lots of great ideas. Maybe if you've got a really good deep tech or technical idea, which you would go to the other Dan for IP protection. You've been working for years in a university and R&D. That's maybe where there's some kind of credit and you want some product to build it. That's maybe where you want to go. But angels is possibly the first place you want to go. Then maybe angel syndicates, angel networks, and angel syndicates, and possibly this new breed of seed fund that we now see, which is kind of like where they're either relying on kind of tax breaks, for instance, normally, some of them very focused, or they're like these baby VCs, which is where the VC community has created these little seed funds, which is just to kind of nurture and keep an eye on the ones that they really think are quite good, such that they can do the follow-on investment. But on the whole, you're first going to go to angels, or maybe angel syndicates, where everyone's kind of, which is really often just a group of angels, just at the end of the day, saying, with their friend Bob and Jane, and they're all chipping in at the end of the day. So, and sometimes that's done where they actually kind of have a fund, where they're managing a fund, but often the time it's where they just kind of, I can drink with him, I'll have a drink, well, I'll nod and everything else, and everyone kind of follows like a bunch of lemmings at the end of the day. So this is the kind of world you've got to do and navigate. And the reality is a lot of startups get rather disheartened about the whole acquiring. What they don't realize is they've got to kiss a lot of frogs at the end of the day. They should have a really good pitch deck, and a pitch deck's not the same as your 20-page explaining your business. This is about acquiring a funding. And Neal and Anthony do a great presentation, which I support in terms of trying to, where you do your pitch presentation, but you also want an investor presentation, which maybe keep on a shared drive locked away for those ones that look for the investors that are interesting, where you kind of have a due diligence. And sometimes you see the really smart startups have several kind of levels for the level of due diligence that they're wanting, different pitch decks with different informations, like your cash flow, your P&L. You might not want to just give that away straight away. So Anthony has spoken about valuation. And I agree with Anthony's approach at the end of the evaluation. It is an art at the end of the day, not a science. I actually quite like startups who kind of do these methods where there's a tick box, not necessarily because that is their valuation, but they're the kind of Burkus method, I think it's called, where you look at your team, your competition, your IP traction, you know, have you got a big cheese on the board, a regulation ticked off? It's a worthy exercise, not necessarily just to use as an argument for negotiation, but it's a worthy exercise for just having a look at, okay, are we ready yet to go to the investor world? This is, you know, what's missing in our proposition. And I said ideas are cheap. It's all about the product, the placement. I'm actually, you know, do I reach this by a shop, by social media? You know, is the marketing done on a billboard, on TV at the end of the day? And then the pricing. Spend some time looking at doing the pricing and, and try and speak to people who really understand about pricing at the end of the day. So there's kind of classic 3 Ps at the end of the day. Ideas Crucible is about 3 things at the end of the day. One is we kind of try and get your pitch deck ready at the end of the day. You know, we want to make sure it's memorable. I spoke to one VC, unfortunately, he showed me deleted 3 pitch decks, 300 pitch decks in front of my face at the end of the day. I said, why you do that? We get so many, we can't process it. We only really pay attention to pitch decks that are from another founder, has been referred to us by our best friend, you know, kind of thing, or someone who's really influential at the end of the day. Now, they do obviously some pitch decks come and get in. They love getting pitch decks. Don't ask me why. I've never really understood the psychology. They really like to get the pitch decks, but they don't get a chance to go through them all. But if they see a pitch deck which is memorable, looks good, as well as has all the right content in, it stands a better chance. And then we advise startups. We help startups scale into America. We help startups in terms of growing and deal with a lot of people issues. Now, we're not HR experts, but we identify them. Anthony's picked up something really important here. Most startup problems that I see are not about technology. They're about people. They've hired the wrong team, they haven't found the right co-founder, there's been a fallout. The investor they took, which offered a big check, actually is a bit of an awkward person that we now need to get off the board and everything else. And fundamentally, there's all the sorts of problems companies find out, and they're often about people about awkward. So make sure you make sure you hire right, you bring the right people on the board, you work with the suppliers that are going to be correct, you trust, have integrity at the end of the day. You spend a lot of time with your employee base and look after them, because a lot of the problems are all about people at the end of the day. And that's not just within your organization, that's within the whole stakeholder network at the end of the day. And then the third thing that we do is we also help you raise capital. So if any of you guys raising capital, sure, you should speak to Anthony. Please please reach out. I'll put my email in the inbox and my LinkedIn at the end of the day. But I'm conscious of time. I'm keen that there's some points that I'm keen to be able to answer some of the questions and sort of open this conversation out, because I know that's something that Neal is keen to have.
Yeah, thanks, Dan. We're very keen to have sort of interaction from people. Don't be shy. Just on the pitch deck side of things, or the pitch ready side of things, Dan B and I are working together on this now. I had a very good friend of mine, I don't mind telling you this, I won't tell you his name, out of Dubai, who sent me a pitch deck. He said, Neal, I'm up to this. The guy's he's a millionaire, but he was raising some cash for, again, a relatively large project. And I looked at the first, and it was a 30-page pitch deck. So first thing I said to him was, Mike, it's too long. And the first 5 pages had, well, the first page had a picture of a super yacht, a jet plane, a house, like a greenhouse and something else. And I read down and I'm like, what's going on? Anyway, cut a long story short, it's some form of product, cleaning products and everything else for cars, yachts, solar panels, everything else. And he was aiming at recruiting ex-service people in the UK initially. And I went, that's great, but the first 5 pages I looked at don't tell me anything. And at the end, there was a statement from a guy who is the head of startups at NatWest Bank in the UK. And it simply said, this is a game changer. And I said to Mike, put that at the top. You don't need a greater endorsement than the head of startups for NatWest Bank in the UK to state your product's a game changer, what you're trying to do. And this is where Dan and I can help you and also Craig, who's online here today. Craig, funny enough, my business partner, who is based in Dubai, on how to entice interest. Because, you know, first of all, and I'll just come on to the raising capital side, and I won't do a pitch slide or anything else, but the biggest reason startups fail is they're offering a product or a service that people don't want. Now, I don't want to see any startups fail. Unfortunately, they do. But so my initial advice to everybody is to have sort of like a 1-page or perhaps maximum 2-page slider that literally goes bing, bang, wash. This is what we're doing. This is how we're going to do it. This is why we're doing it. Not necessarily an ask or an offer. It doesn't even necessarily need to say who, you know, what the name of the company is, and send it out to as many people, you know, through your social works, through your friends and family, social networks and such like, just to gather some feedback to see if you're actually onto something, because there's nothing worse than trying to spend all your time and money developing something that nobody's going to be interested in. So that's
Neal,
my key.
Neal, can I just add a couple of points to that as well? I think when it comes to raising capital, whether it's for an established company or an early stage company, people grossly underestimate how long it's going to take to raise capital. Unless you're raising capital from friends and family for people that you already know, and Dan touched on this as the sort of go-to group to raise capital from. When you're going outside of that circle for someone that you don't know, people buy people first and foremost. They want to buy into the person that's presenting the opportunity, and then they delve into the opportunity itself, so that you have to fit so many different criteria, and people who are especially founders for first time business, they think that they've solved the world's problem with their business, and everyone else who's outside their sector will understand the business, and it'll be a real quick process to do. And maybe this is something Anthony could give us some facts and figures on.
I was just thinking, yeah,
just how long it takes the average funding round for when people come on to SeedLegals to when they actually close. But just in general, people is always be fundraising when you're raising capital for your business. I think that's the key. Be planning ahead how much you're going to spend in the short term, how much you're going to spend, you know, moving forward beyond that. And like Dan touched on, not all capital's the same. Sometimes people come and offer you capital and they're just not a good fit for you and your business. So even though that might be the first check that's been offered and it's light at the end of the tunnel, it's not going to work out well, and you have to weigh in and decide whether that would be something that you're prepared to go down that route or not. Anthony, I don't know if you could give us some figures on those.
Yeah. So I think so fundraising takes often way longer than people expect. I mean, it can easily take 5 months. The question is, where's the time is going? And the time is often not the legal side of things. The time is kissing frogs, so to speak. So it sort of goes something like this. You know, great, I've got a pitch deck. I'll go talk to some investors. Investors, you don't hear back from them. You feel disheartened. Then you go look at SeedLegals pitch deck clinic, and you get some ideas for improving your. So you should look at Google SeedLegals pitch deck clinic, and you'll see a review of pitch decks, and you might then go, eureka moment, no wonder no one's biting, because my pitch deck doesn't make sense. So now also test your pitch deck with friends, ask them to go through it, and at the end of it go, tell me what you think the company does. And if they can't tell you what it does, then it's a problem. So I think the round one is actually figuring out the reason people aren't biting is because your pitch deck wasn't really either explaining what you do or painting an enticing picture why somebody would want to give you money. So now you've updated your pitch deck, which by the way is ongoing, right? Just like updating your product, you're always updating your pitch deck. And now you have to go find investors. And that's the next problem, which is, where do I find investors? So, you know, to find funds are easy on the SeedLegals site. There's a find investors thing, but funds are not useful in the early stage. They'll just say, love what you're doing, come back when you've got revenue. So you need to find friends and family and angels investors. And there, I think, making as much noise as possible to find people, put it on LinkedIn, put it on Facebook, you know, get it out there as widely as possible. Be a bit careful not to go guaranteed return, you know, money back for sure. Just say, amazing idea, lifestyle photo, looking to raise investment, have SEIS advanced assurance, contact me if you want to know more. And it may turn out that you get really good networking. Maybe you get investment ideas, but the more noise you make, the more likely you to find people coming to you. And that's really the longest bit. Once you find investors, then my goal at SeedLegals is to help you do everything to close your round. And there, that goes anywhere from, you know, 2 days to 3 months, depending on, are you still getting people on the bus? Do you have everyone lined up, ready for the bus to go? How many people are there? How difficult are they? You know, are they angels or are they larger? But you should definitely, you know, assume at least a month, hopefully way shorter, but between getting them to sign documents, send money, wait for the last one to send money. And actually that's where the seed fast or instant investment comes in, because as soon as you find one person, you can take their investment rather than have to get everyone on the bus together. So slightly long answer to your question.
I think, Anthony, thanks for that. I think it's important, again, for the people here today to understand is that you've got to have a bus, i.e. you've got to have your subscription agreements in place, your founders agreements in place, everything you can possibly need to raise money. We get startups come to us, go, I want to raise, I don't know, £150,000 under SEIS. You go, okay, great. You know, send us this, send us that. What's your shareholders? What's your share cap table? They go, I've got one share. You're like, well, hang on a minute, you know, you can't raise money. And you need to understand that, you know, and again, use Anthony's bus analogy. First of all, you've got to have a bus. Once, the same old thing, you wait for a while and then they all come at once. And I think that's probably a fair example of raising money, but you've got to have the ground and the documents and everything else in place before you go out there.
I would say a third of the time with the investment, well, the best time is spent with those that prepare. Think about who are the investors you want to approach. Do your research on that, because the thing is, there's a lot of people in the investment world who you ask, oh, are you interested? And they say yes. People like to say yes, they're interested. They're either curious or they want to know further. And you end up sending them information. There's a lot of emails exchange, and at the end of the day, well, not sure. See, hedge your bets with the beginning. Check that they're likely to say yes. Check that they haven't got a competing kind of offering in their portfolio. Check though that they're still interested in your kind of area at the end of the day. Make sure they've got the money. This is something that actually is rarely asked till the very, very end. I know we're all very British, and here, most of us British here. Actually, it's true with Americans, and we don't like to kind of talk about money. But the sooner you can find out whether these, you know, whether the guys and girls have got the money in the bank, it makes a lot for a quicker conversation at the end of the day, because you can spend, I mean, so many startups said, oh, we spoke, we had, they did due diligence, and 9 months later, and he says, oh, I can rustle up £10 million, and he hasn't got a dime to his head at the end of the day. So go through the processes, get the tricky stuff out as early as possible. Make sure you know build your spreadsheet with all the target investors, and the more likely to say edge your bets that you're going to have something right, because at the end of the day, you could spend a lot of time speaking to a lot of people who aren't appropriate.
Yeah, exactly. On our side of things, I'd like to say via Exponential events, we used to, and hopefully again soon, be holding physical events. We hold 3 events a month. One is this one, how to get capital or investment ready. We hold a practice your pitch event, which is exactly what it says on the tin. And then we hold an actual pitch event in front of angel investors, such like. Now, there's other people doing that. I would encourage all startups out there to get in front of as many people as possible. Bear in mind, you know, you're going to pay something towards a pitch event. Our pitch events for seed legal companies are £100, which is absolutely nothing. but it is going to cost you some money to raise some capital as well. So you've got to bear that in mind. One thing we're doing, and we'll send an invite out to everybody, we're launching our Exponential Business Club at the end of the month, which is what we call basically making investing in startups fun. We're offering investors regular savings or membership of the club, whereby they will be gifted shares in startups that we would like to invest in going forward. It's not an advisory service. It's not a regular, it's a regulated thing. It's a purely membership only club. It'll have other benefits as well going forward, including free invites to events and such like. Startups will be invited to put their company info on the site to other members, but it can't be an investment promotion. It will just simply be this is what we're doing. So again, we'll send invites out to that, and the selected, with the pitch events, we run a favorite pitch each month. That will be incorporated to a league table. Doesn't necessarily mean we are going to invest in that company, but the startups we like will be able to offer regular investment into going forward. And for that, the club will take some form of obviously shares at the offer that the companies are looking to raise, perhaps slightly negotiated depending on values that they're looking for. And the idea there is to build up an environment of regular investors with a secondary, ultimately, this is an important thing, a secondary market that's available for investors within the club, or not investors, I rephrase that, members of the club, to resell the shares that they own that they've been gifted in various startup companies going forward on a secondary share market to other members. So if you're a startup and the club, you pitch at our events and we like you, then we will make you an offer to cover your investment, perhaps over a couple of months or 3 months, 4 months, depending on what it might be. But it's something that's not out there in the marketplace for under a membership banner for startups, and that's what we're going to do.
Neal, do we want to ask the audience to see if they want to break cover and talk about some of the challenges they've got with capital?
Sure, yeah, no problems at all. Anybody want to unmute themselves? I think we've got everybody muted, but anybody can unmute themselves. Don't be shy.
Otherwise, I assume the capital raising problems are non-existent. Shy audience, Neal.
We've got a shy audience.
Okay, hello, may I?
Yes, sure, please, the whole idea.
Hi, thank you. My name is Lester. So we are building a software as a service tool which helps small businesses and medium-sized businesses grow their sales and optimize their marketing. So comes like has several tools. We built an e-commerce CRM system, not a CRM that integrates e-commerce, newsletter with a lot of automation. We've probably spent now around £25,000 from our own money. We are planning on spending an extra 20, and we started creating revenue. So we don't know what is the next step. Our revenue right now is like £300-400, and we don't know what is the next step. So from your experience, what would you suggest?
I'll hop in there first. So, you know, if they're two founders, 25K of your own money each is about the median. Sometimes it turns out to be much more. But, you know, I think the point where you can raise external investment is either when you've built enough that you're going to tempt investors, that there is something tangible for them to invest in, or where you can't afford to fund it yourself, or the rate at which you can fund it is limiting the growth of the company. So sometimes, you know, people can fund 5-10K a month, depending on what your you know, assets are. But when at some point you start It's going, well, I can't hire this new person because I can't afford to pay that. And that's really the point. You want to raise external funding. So what you now need to do is you're in the position that pretty much every founder is in, which is you've put some of your own money into it, but at some point it stops making sense to put more of your own money because either you don't have more to put in, or the company's going to grow and start burning enough money each month that you just can't afford it ongoing. So now you've got to create that vortex of desire that get investors to go, great, I'm in. If they see that they can keep waiting because you'll just keep developing it and on your money, then they might go, well, let's just wait for longer. If they see that you're going to go cold turkey and stop investing yourself and the project's going to end, well, that's not an incentive for them. So it's all about creating this desire and this hype that it's growing. We're getting close to releasing, if that's the case. We've got lots of interest. You're going to get articles out there. So an investor has no idea whether anyone really wants what you've got and whether it's going to work. So they're going to start picking up as much signal as they can from the noise. So if you can write blog posts, if you can have a nice looking website, even if it's just a page or two, that shows the benefit to a customer and makes it look as close as possible to that it's ready to go. So if it's some, graphic that talks about the future, it's like, sounds interesting, but it doesn't look like it's anywhere near shipping. If it says, shipping soon, enter your email address and we'll let you know as soon as we're ready for beta testing, it looks imminent. So what can you make it do? What can you do? Really, I think, and now I'll hand over to Dan, which is to make it look like a thing that they want part of. And, I think a perfect example right now is if you're on Twitter and you see Clubhouse and so on, to me, it looks way over-egged, but to many people, it jumps out as it felt like a desire that you want to be on it, either as a user or an investor. And of course, in your small way, how can you create that desire that it's the next iteration of HubSpot or Zoho or whatever it might be? You're going to have, a product that is going to be desirable. And as the investor, this is your chance to get in early at a lower valuation than later. I don't know if I said anything you didn't know, but I hope that was helpful.
Actually, well,
maybe there's a lot of buzz around Clubhouse at the moment. Don't know how much money they're making. Yeah, and Lester, is yours? What's the name of your product?
So we call the company OmniPredict, which is omni-channel and prediction. So what essentially does, we have integration with e-commerce channels, native integration with WooCommerce, and we have a fantastic data team. I'm coming from an IT and marketing background. I have one more company that we do media buy in the United States, one of the biggest in the healthcare section. So what we're trying to build is like, guys, anything that has to do with your e-commerce, we can optimize it in your marketing. We combine these two things together and we optimize how you can make your sales better. For example, automated marketing campaigns, right? From when you have to sell, what time to do media buy, how to increase the lifetime value for your customer, and goes on. We have a very rudimentary website on omnipredict.com. So I don't think we're delivering very well the current status of development, which is much greater than when we made the website 6 months ago.
So a couple of things, Lester, before we're here forever, before it comes to the Lester show. Whilst Anthony was speaking, I had a look at your website. Actually, it's come up with a phishing alert telling me not to go onto the website. So my antivirus picked that up. So if you're going to create a buzz, and I'm just using a standard house name brand antivirus. So which rarely comes up with anything. So you first might want to deal with that because you're trying to attract buzz amongst particularly I guess a community which might be a little bit fussy. So and deal with that. So, but yeah, probably a very good time to be doing what you're doing, particularly as as we're sort of hopefully, I mean, more so in the UK, yet less of coming out of the pandemic, the SMB community, is going to be more, a little bit more attentive to the kind of e-commerce and IT at the end of the day. I still think there's going to be, sadly, a massive crunch in the UK economy. But certainly a year ago, it was struggling with that kind of investment. The one thing I am concerned, you've got several hairs on the go. You've got several things on the go. And startups, I spend most of the time advising them, and it's all about focus. I'd suggest you just put your energy in one of these businesses at the end of the day. Get it working super streamlined and nice, and at the end of the day, and pitch that to the investors. Because if they think you're spinning multiple plates when you're not bringing in any profit and maybe just turning a little bit of revenue, they think you've got a lack of focus. And focus is one of the magic things that I really address when I'm working with startups. I say, focus, focus, focus. Yes, you might have some other great ideas and healthcare and everything else. Just park them and in a shelf for a year, 6 months, and everything else, and then put your energy in that. And also, it means that if you're asking for money, you can just focus on your money from friends and family on one particular project at the end of the day. Investors will like it, and it means, and you can only be in one place at the once. Best of luck.
Thank you very much. Yeah.
Did that help?
Both help. When it comes to the main business, I'm fully detached. I'm working full time on this project. We have a huge team there, like more than 25 people working on it. So I barely attend a meeting per week. I was more surprised with the website, to be honest. It would be okay if I share the link just to have some feedback from everyone, because at least from our side, we cannot see it. So
sorry, you're better off at our pitch event.
Yeah, I was just going to say, it might be good to pitch, get things in shape, build together a nice deck which is clear and sharp, and then we can tell, and then Neal and Anthony can maybe give you some feedback on that as well, because at the moment you're still not crisp and clear when you're articulating what you are.
That would be great. Thank you very much indeed. That would be great.
I look forward to seeing you again.
Thank you.
Okay, does anybody else want to sort of come in and pick up reins, or?
Yes, I do want to do so. Thank you very much. My name's Rosemary Nakasenge, and we do have our company, so Marble Global Investments, and what we are aiming to do, we have created a product which we call the Diaspora Bill Pay, and basically what it is that we are targeting migrant workers to be able to directly.
Okay, Rosemary, can I stop you there? This isn't a pitch event. We don't. Do you have a question on how you can raise some capital? I don't mean to be blunt, but this is a pitch, not an explanation of what you're up to.
Okay. No. Yes, definitely. So at the moment where we're at, we are trying to raise finance, obviously, to help with our cash flow, to help with development of our front end of the business and for marketing, and how best we can do that. Yes, that's the question.
Well, like all things, the answer is to persuade investors that by giving you money, they're going to get a return on their investment. So, for any company, there's sort of the following ways of getting funded. Number one, the founders put some money in themselves, but that's not unscalable too. You go to the bank and borrow money. That works. The bank will lend you money if you have revenue and you can repay it. And since the bank's only going to get a few % interest, they will only lend money if there's got a 98% chance they're going to get it back again. So startups will typically not be loaned money by banks. So debt funding or borrowing money is off the table, which then means equity investment. And an equity investment is an investor saying, I will give you money. It's going to be pretty risky. There's a good chance, a better than even chance, I'm going to lose all my money. But that's okay, because firstly, the SEISP de-risks it somewhat. But secondly, it's because I'm making a bet that there's a 1 in 10 chance or 1 in 5 chance that I'm going to get 10 times my money back or 50 times my money back. So, well, there's a 50% chance I'll get 3 to 5 times my money back. So, it's worth it. So what you need to show them is that it's going to tip over into, this will be a growth company. There are many companies that I see that have fantastic businesses, but actually they're just not right for equity investment. They're a business that feels like a time and material business, or something that will get to cash flow positive and then trickle along, which is great for the founders and the team. You know, you're solving a problem, you're paying yourselves a salary, you're contributing to society. But for equity investment, they're looking for the level up. So for you, you're going to need to show how you're going to have a year-on-year growth of 3 to 5 times initially, and maybe, you know, 2 to 3 times after a few years, and how there'll be a revenue model that scales, and it's not a time and material business. And all of this is to show that after 5 years, the business might be worth some tens of millions, which then entices investors to go, I'll take that risk because of I'm buying into the reward, the return on capital that I see later. I know that, you know, obviously I don't know the facts on your business, but it sounds like that might be the missing link to focus on to entice investors.
Yes, no, you're definitely right. Obviously, we have started trading, and straight from the word go, we have got quite a high rate of users, you know. And so obviously with this kind of business, so what we find in terms of our cash flow, people expect instant pays to their service providers, whereas the model that we had in place, if we can provide the next day payment to your service provider, you know, so, but for example, for somebody sending money, you know, for grocery bill for their family, whereby the relative is waiting in that supermarket, they want instant pays, you know.
Okay, so you're in a space which is, you know, there are companies raising at huge valuations in, you know, debt. I mean, you know, for your customers, it's kind of cash flow advance and things like that. So it's a hot space. So if you get it right, and you've identified a market segment, there's nothing from what you've said that suggests that it can't be a really attractive investment. But then it's all about packaging it up, showing the go-to-market strategy. We won't go through this more now because firstly, I'm out of time, but I think we've hit the hour. But you know, welcome to drop me a note with a pitch deck, Anthony@seedlegals.com, and I'll see if I or my team can provide some feedback on that.
Thank you very much. Thank you.
Thank you.
Get your feedback.
Just to let everybody know, we've recorded this event, so we will we'll pop that up and we'll send everybody a link to it. I've got the chat as well, which I'll send to Dan, RG, and Anthony, so they can also respond. But at the same time, you've got all, and again, you'll get information on all the contact details, so you can contact them directly as well. Our next event coming up, we're going to do it's on the 27th. Again, I'll send information on this. Which is the launch of our Exponential Business Club. We've got about 100 registered already for that, so we're looking forward to it, but we've got a couple of hundred spaces available. So again, we'll send links out to that, and we'll explain what we're up to, and we'll probably integrate that into what we were going to hold 2 days before, which is the end of the month pitch event. So we'll probably put a couple of pitches together for that one as well, just to add a bit of spice to the recipe. But again, Anthony, Dan B and Dan RG, thank you very much indeed, and thanks to everybody for coming today, and we look forward to helping you on your capital raising journey going forward.
Thank you everyone, and sorry we didn't get to answer all the questions. If you do have any that certainly directed me, pop me an email and I'll see what I can do.
Awesome. Brilliant.
That's great.
Thanks, everyone.
Thanks everybody.
Thanks.
Have a great afternoon or evening wherever you
All
might
right,
be.
enjoy the sunshine. Okay,
Take
bye.
care. Anthony,
Bye.
thanks very much.